Imagine losing everything you work for and never seeing it coming. That is the reality for thousands of London property owners right now. Prices in free fall, demand completely gone, entire areas left for dead. Communities that held promise are now in structural decline. These are the 10 hardest hit London areas in 2026, starting with the worst. Number 10. Hammersmith and Fulham. Hammersmith and Fulham has experienced the steepest property price decline across West London's traditionally premium postcodes. The borough recorded a 7.5% annual price fall to February 2026. That is more than double the London average decline of 3.3%. Flats have been hit particularly hard, with new build properties seeing the sharpest losses of all property types. Data from Hamptons shows that in Hammersmith and Fulham, 2/3 of all flat owners who purchased new build properties sold at a loss last year. This is not a neighbourhood experiencing temporary soft market conditions. This is a sector where the fundamental dynamics have shifted permanently. Young professionals with buying power are looking elsewhere. Family homes command different value dynamics than flats, but across the borough, the narrative is consistent. Prices purchased at the 2015 peak have not recovered in real terms, and the gap has widened. For property owners considering their position, the rental market offers little consolation. Rent have remained essentially flat at around £2,724 per month, with no meaningful annual growth, while mortgage costs have nearly doubled. The combination of falling prices and stagnant rents creates a deteriorating yield scenario for investors. Number 9. Newham. Newham recorded a 6.1% annual house price decline to January 2026, significantly worse than the London average. Flats declined by 7.5%, revealing the borough's structural exposure to London's oversupplied flat market. The borough sits on the lower Lee Valley, where deprivation concentrations are highest in the entire London region. Multiple Newham wards rank in the worst decile nationally for income and employment deprivation. Paradoxically, rents have risen by 8.5% annually, an indication that while investors chase yields, the underlying property valuations have declined. This creates an uncomfortable scenario for property owners. Rents rising while purchase prices fall means new buyers entering the market will achieve better returns than existing owners holding their purchases. The Stratford regeneration narrative, while genuine, has not translated into sufficient asset appreciation for most residential property holders. The data from the Indices of Deprivation 2025 shows that the economic foundation that would ordinarily drive neighbourhood property recovery has not strengthened. First-time buyers paid an average of £386,000 in January, down 6.2% from the previous year. Number 8. City of Westminster. City of Westminster has experienced the steepest property price decline in London. Official figures from the Office for National Statistics show that prices tumbled 12.7% in the 12 months to February 2026. This cut average values by approximately £127,000, from close to £1 million to £872,000. Areas including Marylebone, Maida Vale, Bayswater, Paddington, and St John's Wood have all been significantly affected by the collapse. The luxury property market collapse shows no signs of reversal or stabilisation. Flat prices fell particularly sharply as investors reassessed premium central London valuations they had held for decades. Foreign investment that once sustained Westminster prices has retreated significantly. Asian and Middle Eastern capital that dominated Westminster transactions has moved to more stable markets. The rental market provides no compensation for falling capital values. For property owners who purchased during the London property boom, Westminster represents concentrated wealth loss. Wealthy foreign investors can hold and wait for recovery. Ordinary owner-occupiers are trapped with negative equity and illiquid assets. Subscribe right now and hit the bell. The areas still to come have seen property values fall in ways that will genuinely concern anyone invested there. And number 1 is the data that every property owner in South London absolutely needs to understand before making any holding or exit decision. Stay with us. Number 7. Brent. Brent stands out in one specific and unwelcome way. It contains St. Raphael's, identified in the 2025 indices of deprivation as the single most deprived neighbourhood in the entire London region. The borough's deprivation is not random or marginal, it clusters in ways that make economic recovery difficult. The Neasden, Willesden and Harlesden corridors experience overlapping income, employment and health deprivation that compounds each other. Young professionals do not relocate to these areas. Existing residents with purchasing power exit to surrounding areas. Property prices are low, which sounds positive, until you realise that low prices in areas with negative economic momentum typically continue declining. The buy-to-let rental yields look attractive on spreadsheets, but they ignore the reality of tenant selection in the lowest income boroughs. These realities include longer void periods, higher maintenance costs on older housing stock, and concentrated deprivation in neighbourhood appearance and amenity. For property owners in Brent, particularly in the most deprived wards, the underlying demographics and economic trajectory work against sustained property value retention. Number 6. Tower Hamlets. Tower Hamlets recorded a 9.5% annual house price decline to January 2026, with flats declining by 9.8%. Over 40% of residents live in income-deprived households, the highest concentration in London. The borough has the worst child poverty rates in the entire United Kingdom, with life expectancy 4 years below Kensington and Chelsea. Population density is extraordinary, 112 people per area the size of a football pitch, compared with 3 nationally. The council has faced £200 million in budget cuts over the past decade, fundamentally constraining services. Homelessness applications linked to relationship breakdown increased by over 700% between 2020 and 2025, reflecting stress on family structures. The borough experiences concentrated, overlapping deprivation across income, employment, health and housing. While the Isle of Dogs has seen investment in high-rise apartment development, the economic benefit to the wider borough remains markedly limited. For property owners in Tower Hamlets, the underlying demographics and economic trajectory point consistently downward across multiple indicators. Number 5. Southall. Southall in Ealing occupies an unusual position. It is positioned as London's affordable gateway, with average prices around £420,000, yet it sits on the deprivation cluster that extends around outer London's least economically integrated areas. Southall experiences housing quality deprivation comparable to central London's worst neighbourhoods. The High Street has not recovered its pre-pandemic vibrancy. Retail vacancy rates exceed sustainable levels. The demographic profile shows age stratification, with older, lower-income residents and younger professional residents moving outward to Uxbridge or beyond the M25 entirely. Property purchases in Southall over the past 7 years have been driven almost entirely by overseas investment and buy-to-let investor activity, rather than owner-occupier demand from London professionals. That investor-driven demand is now cooling, as the implementation of the Renters' Rights Bill and higher mortgage costs reduce investor margins and profitability. For existing owner-occupiers in Southall, the purchase premium relative to the asset's utility, what it actually costs to live there, has compressed significantly. The value proposition that made Southall attractive to budget-conscious owner-occupiers in 2015 no longer exists. Number 4. Enfield. Enfield presents a particularly clear problem. The borough contains multiple wards in the most deprived decile nationally for income, employment and health outcomes. Unlike some London boroughs, where deprivation clusters in specific postcodes, Enfield's deprivation is distributed across multiple areas, which makes any narrative of local regeneration unconvincing. The River Lee corridor, from Stamford Hill through Tottenham to Edmonton, concentrates deprivation in ways that investment announcements have failed to materially affect. Older housing stock dominates. Yield-focused landlords entered the market to capture returns on the cost differential, but tenant income constraints limit rent growth. Young professional workers based in the city or the West End identify significantly better residential options. Enfield property prices have stagnated for a decade. The borough's position on London's orbital motorway makes it convenient for commuters, but convenience does not drive appreciation. Demographics are not improving. School catchment areas are not competitive compared to outer South London. For property owners in Enfield, particularly in the most deprived wards, the value proposition was always contingent on income growth and neighbourhood amenity improvement that have not materialised. The City of London experienced an 11.2% annual property price decline to February 2026, making it one of the worst performing boroughs in London. This historic financial and commercial district, the centre of London's economic power, has seen property values collapse as the investment thesis supporting central London property fundamentally broke. The city's property market is almost entirely flat-focused, making it particularly vulnerable to the structural collapse affecting London's apartment sector. More than 1 in 5 sellers made a loss on their transactions, a proportion exceeding most other London areas. The rental market offers no compensation as corporate relocations and remote work reduce demand for residential space in this concentrated central location. For property owners who purchased believing the city location represented a premium asset, the past year delivered a stark reassessment and negative equity. The employment base that supported premium valuations has been disrupted. London's financial sector remains intact, but property values have corrected downward to reflect a genuine scarcity of buyer demand at the previously elevated price levels. Number 2. Hackney. Hackney is identified in the 2025 indices of deprivation as the most deprived borough by average rank score, meaning the borough experiences consistent, multi-dimensional disadvantage across multiple deprivation measures simultaneously. Income deprivation affects over 40% of residents. Employment deprivation is significant. Health outcomes rank among London's worst. The property market has nonetheless experienced investor interest based on the narrative of gentrification and cultural district development, but that narrative has run ahead of reality. The V&A and other cultural anchors have established a presence, but the economic integration of these institutions into the surrounding residential economy has been limited. Young creative professionals do live in Hackney, but they live in specific conservation areas and converted warehouse lofts, not in the surrounding residential stock. For conventional residential property owners in Hackney, property price appreciation has been marginal despite investor activity in specific micro areas. Flats have underperformed houses. Older housing stock carries maintenance costs that compress net returns. The rental market is driven by density-seeking renters with limited income elasticity. For property owners considering their position, Hackney's deprivation indices suggest that the underlying economic foundation supporting sustained appreciation is weaker than recent investor enthusiasm would indicate. Number 1. Stratford. Stratford in Newham has been the subject of a regeneration narrative for 2 decades. The Olympics investment, the subsequent redevelopment of the Olympic Park, and the opening of major retail and cultural anchors are all genuine developments that create a reasonable story of neighbourhood transformation. Yet the property data tells a more circumscribed story. The Olympic Park redevelopment has improved public realm and leisure amenities, but it has not generated sufficient employment concentration or resident earning power to drive sustainable property appreciation across the wider neighbourhood. The deprivation indices show Stratford sitting within the cluster of highest deprived neighbourhoods across East London, from Whitechapel to Barking. Income deprivation affects the wider Newham population at rates comparable to Tower Hamlets. School performance remains weak by London standards. Property purchases in Stratford have been driven by yield-seeking investors betting on future regeneration, not by owner-occupiers establishing primary residence. Rents have risen in nominal terms, but this reflects general London rental inflation, not Stratford-specific amenity improvement. For property owners in Stratford who purchased on the basis that the Olympic Park and subsequent developments would drive sustained property appreciation, the experience has been disappointing. The asset has performed in line with broader Newham trends, not in line with the regeneration narrative. The heaviest concentration of new build activity has been in purpose-built rental schemes, which reduces the owner-occupier property market. the future trajectory is uncertain. Deprivation indices are not improving at the rate required to shift the underlying property value trajectory. These 10 London areas are not written off. Communities survive, people adapt, and some of these places will experience genuine economic recovery and neighbourhood transformation. But the data available in 2026, from the indices of deprivation, from house price statistics, from rent growth analysis, from employment data, points clearly to where property owners face the most significant headwinds. Property ownership is fundamentally a bet on future economic trajectory. Make that bet with the long-term data, not with the short-term optimism of someone with a financial incentive to shift your property. The information is public, yet most property owners never examine it. Now you have. Consider carefully what the 2026 data is telling you about your borough before making any decision you cannot subsequently reverse. Subscribe and share this with anyone making a property decision in London today in 2026. The analysis is sound. The implications matter greatly for all property holders.